Well, almost 5 years ago, Obamacare was signed into law. More big changes go into effect next year. So how will the changes affect your tax bill? Joining us now is Al Gobo, certified financial planner with the U.S. Financial Services. Al, first of all, what are you going to see? Are you going to see any reference to Obamacare on your tax forms?
Absolutely. I mean, this is the first year that some folks will see something very dramatic. First of all, Obamacare is going to raise $1 trillion in taxes, so it's got to come from somewhere.
Holy mackerel.
And Obamacare imposes three different things. Says, number one, you either have to have a minimal essential coverage. Number two, you have to have an exemption, qualified exemption to get out of that. Or number three, you have to have something like a penalty or tax imposed on you. And the number three part is what some folks are going to see. So come April, when some people are filling out their tax return, they're going to be asked, do you have health care insurance? And if they don't, they're going to have to pay $95 per adult, all right, with a cap.
Or a percent of their income, whichever is more. They have to pay what is more. And the question now is how the government penalizes people who decide not to pay. They can only penalize, they can't take money out of your bank account. They can only penalize you by giving you less money in return, right?
If you're getting a refund, which is some folks, if you're getting a refund, they're going to keep part of that refund, but there's no way right now that they're going to come after you for that money. But that's only one thing. The big money is going to come from what I call the stealth taxes, the ones that we really don't see. So they impose a tax on hospitals, on insurance companies, on the medical device manufacturers, and eventually that trickles down to the taxpayer because we pay more.
It's passed on. All right. Before you go, here's a big question about a lot of people it's hard to find many losses, frankly. The markets have been so up recently. But if you have a stock that shows a loss year over year from the time you bought it, do you sell it now, book the loss, and get the tax deduction?
Here's the thing. I never let the tax tail wag the dog. So it's an investment choice first. If I don't like the investment and I think it's going to continue to do poorly, I sell the stock, sell the fund, whatever. However, and there's only 1 day left to do this, if you have some realized capital gains in your portfolio that you're going to be paying taxes on, why not take a look and see if you have some unrealized losses that you can use to offset the gain? So if I have a $10,000, $20,000 gain, why would I want to pay 20% on that gain? Whereas I can take a stock, fund, ETF, whatever, sell it, book the loss, and offset the gain.
Al Gobo, good stuff. Thank you very much. Appreciate you being here.